This is the second of the two videos on monetary policy. In the first video, we just kind of reviewed the question, what is money, what are the functions of money, what does the money supply consist of. We also talked about the fractional reserve system, about how the banks are mere intermediaries. They take deposits from people with a surplus of cash and lend them out to people with a deficit of cash. Now, they can't lend out all of their money. The Fed, which we talked about in the previous, just alluded to in the previous video, will not let them lend out all of their money. They must keep a certain amount of money in the bank vault. That's so you and I can go get our little bit of money out whenever we want to. The amount of money that they must keep in the bank is based upon the reserve ratio. 10%, 15%, whatever it is. A certain fraction of the total reserves on deposit in the bank must be held in the vault at all time. And so this is money that they cannot lend out. We also talked about the deposit insurance and the FDIC and all of that. So now we want to talk about monetary policy. Monetary policy is another way in which the federal government can influence the level of economic activity. In a recession, of course, the federal government will want to stimulate the economy, increase the level of economic activity. During inflation, the federal government might want to slow the economy down so that the price level would fall. So the idea is that the Fed, the monetary policy rather, is the other way, in addition to fiscal policy, in which the government can smooth out the business cycle. Monetary policy is enacted through the Federal Reserve System. The economists just refer to this as the Fed. The Federal Reserve System is a system of banks whose job it is to regulate banks and implement monetary policy. Now, what is monetary policy? Monetary policy is influencing interest rates. That's basically what it is. If the Fed can enact a policy that will cause interest rates to go down, purchase of big ticket items will become cheaper for you and me, investment spending by firms will increase, interest rates go down, borrowing goes up, the level of spending goes up, the level of economic activity goes up. Implementing a policy that is designed to lower interest rates, this is called an expansionary policy, expansionary monetary policy. The idea is to increase borrowing, increase spending, speed up the economy. The goal of an expansionary policy is to fight unemployment. A contractionary policy, on the other hand, or a tight money policy, is designed to raise interest rates. This would reduce borrowing, reduce spending, and cause the economy to slow down. This would be for the purpose of fighting inflation. Now, there are three ways in which the Fed can implement monetary policy. One way is through the reserve ratio. Reserve ratio, recall, is the proportion of total deposits, called total reserves, that must be held within the bank vault at all times, cannot be loaned out. Now, if the Fed were to raise that ratio, the reserve ratio, then the banks would be able to lend out less. They would have to hold more in their vault, be able to lend out less. Now, the supply of loanable funds, money that they could lend out, the supply of loanable funds would go down, and of course, when the supply of something goes down, the price goes up. So, by raising the reserve ratio, the supply of deposits that the bank could lend out, the supply of loanable funds would go down. This would increase interest rates. Or, on the other hand, the Fed could reduce the reserve ratio. This would automatically free up some of the deposits in the bank vault to be loaned out. The supply of loanable funds would go up, interest rates would go down. The second way in which the Fed can influence interest rates is through something called the discount rate. Now, the Fed acts as a banker's bank. The functions that a bank performs for you and me are the very same functions that the Federal Reserve banks perform for the commercial banks, including lending it money. If a bank were for some reason short on money, if it couldn't pay its depositors, if it couldn't meet its reserve requirement, it might have to borrow some money, and it can do so from the Fed. However, the Fed's going to charge them an interest rate, and the interest rate that the Fed charges the commercial banks is known as the discount rate. If the Fed raises the discount rate, all of a sudden the bank's money costs more, and they will pass this on to the borrowers in the form of higher interest rates. Just the opposite happens if the Fed chooses to lower the discount rate. And so the Fed can manipulate or influence the interest rates that the commercial bank charges you and me through the discount rate. The third way is the way that is most often used, and this is called open market operations. Open market operations are the buying and selling of U.S. government bonds. The Fed can sell a bond to a bank, and if the bank buys the bond, it has less money to loan to you and me. If the Fed buys a bond from the bank, the cash goes to the bank vault, and that's money that they can loan out. So the Fed, through buying and selling bonds, can manipulate the amount of loanable funds in the bank vault, and thereby influencing interest rates. Once again, let's run through this. Let's suppose that the Fed wants to impose a tight money policy. That is, they want to fight inflation and they want to raise interest rates. They would do this, of course, by lowering the money supply. That is, lowering the amount of funds that the banks have in their vault to lend out to borrowers who are going to spend it. They can do this by selling U.S. Treasury bonds to the bank. The bank will use the depositors' funds to buy that bond, and the bank will earn interest on that bond. But the cash in the vault goes and sits in the Fed. It's not available in the vault to loan out, and so the supply of loanable funds goes down. So if the Fed wants to implement a contractionary monetary policy, a tight monetary policy, if they want to raise interest rates, they will sell bonds to the banks. On the other hand, if they want to implement a loose monetary policy, an expansionary monetary policy, if they want to lower interest rates, which they have been doing for the past, 5 years since the Great Recession, what they would do is buy bonds from the bank. They would buy the bonds from the bank or whatever financial assets or financial instruments that the bank has. The Fed would buy the bonds with cash. The cash would sit there in the vault. Now the bank has an excess of funds to lend out. How's it going to get rid of those extra funds? By lowering interest rates. So, in order to implement an expansionary monetary policy, a loose monetary policy, in order to lower interest rates to fight recession, the Fed will buy bonds from the banks. I knew I was going to mess that up. If you have any questions or comments, please post them in the Quiz 5 forum on the discussion board.